Hey guys, Zach Scheit here for the Rich Retirement Letter. And today I want to introduce you to three companies that have already reported second quarter earnings and they're moving higher following great news from the companies. Now, all three of these companies have actually increased their guidance, which means that they're telling investors to expect more growth in the quarters ahead. And that's helping to drive more confidence for investors. Now, these three stocks are in the industrial sector, which is an area that's benefiting from the overall economic rebound following the coronavirus crisis. And while there's some questions about the Delta variant and how fast it'll spread and how deadly it'll be, what we're realizing is that this is not big enough to derail the overall global reopening and the growth of our overall global economy. So these three companies are situated perfectly to benefit from continued growth across many different industries. And they're areas that I want you to invest in right away because we're starting to see momentum build in these stocks, which means that you can buy now and expect much higher stock prices over the next few weeks, over the next few quarters, and even over the next few years. So the first company that I want to introduce you to is Raytheon Technologies, which is ticker RTX. Now, this company has a commercial and a defense side. The commercial side is well known for their aircraft, for their aviation engines and so forth. And then their defense side is known for missiles, satellite systems, and many other high-tech areas. Now, the company actually reported great earnings last week. They beat expectations, and the management team actually guided higher thanks to their strong commercial aerospace business. Now, the management told investors to expect $3.85 to $4 per share for this year. And then next year, Wall Street analysts are expecting $4.95 in profits. So that's strong growth both for this year and for next year, which is what we're seeing helping to drive shares of Raytheon higher just over the last few trading days. Raytheon actually has a 2.3% dividend yield, and they're trading around $87 a share. So they're not super cheap. They're trading about 21 times this year's expected earnings. But when you look at their earnings growth, for instance, next year they're trading at about 17 and a half times next year's earnings. That growth is actually helping to drive the stock higher, even though they're not super cheap. So I actually really like Raytheon as kind of a momentum play in this industrial sector, and it's one that's definitely benefiting from strength in the overall area. The second stock I want to show you today is UPS. Now, this stock actually traded lower after their earnings report, as you can see, but keep in mind, this is after we saw just a tremendous surge for UPS just a few weeks ago. So basically, it's consolidating its recent gains. And I want to tell you what happened on this earnings report to cause investors to sell their shares and to move the stock lower. Basically, management told investors that growth for the coming year is not going to be quite as strong as the growth for this past year. Well, no kidding. This past year was a year that we had so many people ordering things from Amazon, doing all kind of shopping online instead of going out. So as the economy reopens, a lot of these purchases are going to be done in person instead of digitally. However, just the fact that UPS is continuing to grow, even if it's less growth on top of last year's great results, shows us that this is still a growth company, and the pullback actually gives you a great chance to buy shares at a discount. So right now, if you buy shares of UPS, you're paying just 16 times expected earnings. And with the bar set so low, you can now expect for the company to come in and potentially surprise investors at the next quarterly announcement. After they set the bar so low, it's a lot easier for them to over deliver. No pun intended for the UPS brand. And so I still think there's plenty of growth, and this is a great opportunity to buy this quality dividend name at a discount price. Now, our final stock is Honeywell. And as you can see on the slide, Honeywell is in a lot of different areas of the overall economy: aerospace, buildings, chemicals and materials, healthcare, manufacturing, and much more. Now, the stock is actually hitting a new high after reporting earnings. And a big part of what's driving this company higher is a couple industries that were really unexpected as far as how strong they would be. The first is the energy industry. Now, as oil prices move higher and drillers start to drill and try to actually bring supply back up as the overall economy increases, that's driving a lot of profits for Honeywell and some of the services that they offer to these drillers, pipelines, and so forth. And then the second one is factory automation. So as it's becoming more and more difficult for factories to hire workers, Honeywell is stepping in and saying, hey, listen, we know the job market is tight. We can actually help you do more as far as manufacturing goes with less people. And so they're benefiting actually from this weakness this overall tightness in the job market. Now, the stock is trading at about $235 a share, which is 29 times this year's expected earnings. But keep in mind, Honeywell is growing their earnings over time, and we're expected to see a lot more profits. And in fact, they could surprise investors again and again, thanks to their strong growth in so many different areas of the economy. The stock gives you a 1.6% yield, so you're getting paid to hold these shares. And as I mentioned, they're moving to a new high right now. And that's the kind of thing that can drive momentum, drive excitement, and move more traders into this stock to help propel shares higher. Again, I'm Zach Scheit with the Rich Retirement Letter. I'd love to hear what you think about this video, so please leave me a comment or shoot me an email, richretirementfeedback@stpaulresearch.com. I look forward to hearing from you, and I hope you have a great week in the market.